Good afternoon, and welcome to the Gatewood Wealth Solutions weekly market commentary broadcast. This is John Gatewood, and with me today is Aaron Tuttle, our Chief Investment Officer.
Not the Chief Technology Officer.
Well, we may have to use your technological skills if we get messed up in our broadcast today. But just so you know, this broadcast is being recorded for future use. So the virtual National Democratic Convention started on Tuesday.
Isn't everything virtual in 2020?
It is. We just finished a virtual conference ourselves, and this one's going to run through Thursday. Biden now is the official Democratic candidate for president, and tonight Kamala Harris will accept the vice presidential candidacy nomination. But what impact do conventions like this have on two things: voter choice and market movements?
You know, I think the conventions are really a relic of the past, and they're really done as a production show, and there's still some value we do them, but I don't think they have too much of an impact on election or what people are selecting. You tend to get a bump after a convention because you're rallying the base, and they used to provide an opportunity for everyone within the party to get together, but we're talking about a virtual world in 2020. They just seem to be something that we do for history's sake, and also having that production and being able to get the message. So I don't think they really have an enormous impact on the election. I think the debates have a bigger impact.
So we wouldn't really expect, let's say, a market movement because some dramatic thing was revealed at the convention.
No, I think everyone pretty much knows what the platform's going to be. We just have a lot of information that will be known well beforehand prior. And I don't think that was the case, let's say, 50 or 60 years ago. That was probably a big revealing, especially whenever it was getting on a public television to communicate. Well, I mean, we got information coming at us all the time now, right?
Right.
There's speculation in betting markets on who the vice president's going to be. You would have never known anything like that unless you were in the deep politics in, let's say, the 50s or 60s.
So let's move on to your presentation today to see about where we are in the market.
Sure. So everyone is familiar again with our coronavirus timeline. We continue to make progress. We're continuing that slow climb and an uncertain climb at times out of the deep recession that we were in. And also we're starting to see that industrial activity come in. We're going to talk about the CPI numbers. We talked about the PPI numbers last week.
Right.
But they did come in, and some of our concerns about high inflation risk. We definitely took notice of those numbers, but we'll save that for a little bit. Coronavirus, I know everyone is just excited and eager to get into the news on coronavirus. We continue to see the cases decline, and if you look over here on the far left, there's actually a little bit of a flatness, and I'm going to mention that. So just remember that. A little bit of a bump right there, the little flattening in the cases, but we continue to see a drop in new cases, which is good news. We'll continue to see hospitalization go down, all positive news whenever we're considering the virus. And we've continued to look at that lag, comparing the daily death count to the new cases. And whenever we first started doing that, we were looking at the 4 to 5 week lag. And saying, well, we're seeing these new cases, but we're not seeing them show up in the daily deaths. To the point that I think about 5 weeks out, we pointed out that there must be something different. And then sure enough, once we made a public statement saying we think the new cases are something different, then we finally started to see that increase. But it took 4 to 5 weeks. So as we're seeing here, we definitely see a slow in the growth of the daily deaths. So we think we have peaked, but we don't know why we took 4 to 5 weeks to see that uptick in the daily deaths. So I wouldn't be surprised to see a 4 or 5 week lag on just kind of these elevated numbers where we're averaging around that 1,000 daily deaths. Once again, don't know the reason. I'm just looking at the pattern and saying, how much of the coronavirus do we not know about? Here's just another one to add to the list, what we do not know.
So here's the thing that people are concerned about, though, is that you hear talk about the flu season coming. We have an influenza season in the fall, then we have a flu season in the winter. The coronavirus is not going to go away. It's not like it magically disappeared, but that's going to be additive to what is normal. So now that everybody's so sensitive about the, possibly contracting this or the spread of this. How do you think this might impact further shutdowns by governments?
Well,
I mean, that's really the big impact that
I
we're
think that is the
concerned
big
about.
impact, because I think the coronavirus is a specific kind of virus. It's actually the cold virus. They mutate just like the flu virus mutates. It shouldn't show up in the fall if it acts like the typical coronavirus, but once again, we can add something else to the list of what we don't know of this virus, right? So we would expect to see it at the end of winter, early spring. Also, the population will be less susceptible to it because we'll have more people that have been exposed to it. And there's been a lot of new medical advancements. So there's a reason that we see a far lower daily death rate relative to new cases as well. But to your point, the big thing, at least from the economic standpoint, is the shutdown. So once you set precedent and use that as a strategy, I think it's more likely that politicians would implement another shutdown, whether it's for coronavirus or even possibly a bad flu. They're going to react to that, or at least it's more likely that they'll react to that. So I think as a society, as a civilization, as an economy, we will begin to take things like that into consideration. We definitely can operate better now than what we did, let's say, back in March or April with the shutdown. I mean, how many people are getting their groceries delivered? It's not just Amazon dropping things off. How many things are now delivered from Amazon? And how many conferences are virtual? How many Zoom meetings are we having? So I think the economy can adapt to it, but it's certainly going to slow the ability to grow going forward if we have to take some of that ingenuity and that things that could have been applied elsewhere, and we have to try to solve this situation. So I think that the markets also will probably put in some type of risk premium so that if we do see any type of other component that could cause governments to put shutdown. So I think this is a concept that we have to be thinking about, where back in January, we weren't even contemplating a lockdown. We were contemplating, well, what would the death toll be? That was not in part of the equation anymore. And we criticized China for their lockdown and the way that they handled it at that time. So it's definitely something we want to consider going forward. On the next slide, and getting to that, this is just kind of that progression of how the virus went through the Sun Belt component. So not the Northeast and Washington and California's been through the whole thing. And we can see that we're now to a point where we've seen those hot spots arrive, especially in the urban areas, and now it's really spread and there's a lot of yellow. It's dying down, but we think that movement to the rural areas out of the urban areas in the Southern Belt is the reason we had that flat part of that plateau, because it is moving in the rural areas. There's just not enough population, and it goes a little bit slower, being less dense. So we do think that part has passed, and hopefully we don't see a fall or spring type of return of the virus in the way that we saw it, let's say, in March or April.
Right.
And that's very unlikely, because there's going to be so many more people that will have immunities to it relative. You don't usually get that big exponential growth a second go round, because so many people
Well,
are
let's
less
hope we have a
susceptible.
vaccine by that time. That'll be good too.
Well, there's questions on how effective is it. You think of the flu vaccine. We have plenty of flu vaccines. And the flu is always changing. Are they 40, 50, 60% effective? Dr. Fauci has mentioned that it's probably not going to be a highly effective vaccine, just similar to the flu, that you just can't really map it that well. And one of the reasons is because it does mutate. Here we're looking at a chart and seeing the states that have actually had the top 10 to experience death. And we can see New York, New Jersey, California are all up on the list, as well as Texas and Florida. Florida recently, since we put this together, has crossed over 10,000 deaths. And another way to look at it is to look at the top 10 versus deaths per million. So really, it's that northeastern part of the country that really got hit hard, minus Louisiana. Everywhere else is that New England area. And as they were early, it was still that part of the season. They didn't know how to deal with it medically, so there's reasons. Nonetheless, they had the stricter lockdown procedures. And Probably, it's not to say that they had worse outcomes because they had a stronger lockdown. It's they most likely had worse outcomes and needed to bring a stronger lockdown trying to stop that. But having a stricter lockdown did hurt them economically because we have sales tax and other things that these states need to fund themselves with. And New York and California, both being very big budget states, really have a lot of issues with trying to generate revenue, and they didn't have the option to have the sales tax and other activity that they tend to use to try to cover that gap, and their gap was just bigger. So we're starting to see some wealth tax rumbling and proposals. Now I have the governors up here. They're not the ones that are proposing it. Governor Cuomo is actually warning against a possible exodus if they were to come out and put a wealth tax. And then California, I just have Governor Newsom up there because I have Cuomo up there, and I just want to kind of keep it parallel. But his legislative branch, I don't know if he supports it or not, they are also advocating a nation wealth tax. And one of the things that we've talked about as a theme and something that we've seen for quite some time, one thing that accelerated it was the state and local tax deductions, right? We see a movement of people away from California and New York, more of those higher taxed areas. And I don't know that it's necessarily the higher tax, but people are leaving those states for other states such as Texas and Florida. And the wealth tax, the shutdowns seem to have accelerated it. Well, why is that important? Well, it's important because of where they're leaving. California, blue state, and Texas and New York, a blue state, and they're tending to fall into Florida and Texas and Arizona. And how does this impact the Electoral College going forward on elections? We say that's the important part. And if Texas is picking up additional residents, especially if this started out in March. One of the things that the investment committee is asking is, well, voter registration, you need to be there for 6 months, 1 day. If you went down in March, you could be eligible. Are we going to have people changing their state registration to be able to vote? Because if you have a lot of blue state population moving into kind of a purple state, Florida, that could have an impact on the election. We don't think it's a big factor for this election, but if these people are not moving back to New York and it's just an acceleration of
So
that.
certainly over the next 2 years before the next election cycle.
Right, it's something that we want.
Different.
Yeah, so we are absolutely watching that. Also, if you're opening a business or you're running a business, you probably want to start looking at some of these cities that are getting a lot of flow, right? Miami, Houston, Dallas, Nashville, that's where people are going. And that's probably where you want to look. If you're thinking about opening up a satellite office, these are the areas that you want to get to, especially if we've seen the climax and the population max of New York and San Francisco and LA, which are areas that are seeing 10 to 15% drops in rent. So we don't think this is just arbitrary. It seems to really be happening there. Those might be areas that you want to get into early for a potential move as those big cities move to the south through population decisions, right? Which all of this gets us into that electoral map and what's happening. And we just have the convention. We know about the polls, right? Biden is winning the national poll over Trump at the moment, and this is kind of an aggregation of all the polls. And we wanted to also look and say, well, it's not about the national polls; it's about the Electoral College. What would happen if we just say, who's the winner? If we don't have any toss-ups, anyone that leans Democrat will vote Democrat, and anyone that leans Republican would be Republican. We can see that currently, based on that assessment, Biden would win the presidency. However, when we look at that toss-up, when we start to look deep into the numbers, and it's down here on the bottom right, we can see that Biden had a lead in the Electoral College of 9, 10, and that has been dropping since June. So there's still a long time. Another way that we wanted to look at it is we were comparing how is Biden's lead over Trump compared to Hillary's lead over President Trump in 2016. And going into the coronavirus, Biden's lead was substantially higher than Hillary's lead but he did drop, kind of coordinated with a lot of the riots and protests, and he still does have an advantage over Hillary, but it's really narrowed as we're going into this convention. And we have talked about that's the next slide. The other thing that we talked about was Florida. This is a busy slide. Don't try to figure it out, but it's just trying to get under the hood and really try to find the latest data. And using 538, they have a great program on how to try to take some of the unintended or intended biases out of the polls. And we can see Zogby's poll actually has them at a dead heat in Florida. And we think that's the state really to watch for this election.
So I think the most important thing is, I mean, certainly we want to know who we think, as we get closer, is going to become elected.
Yes.
But of course, we won't know for sure until on election day. But the more important thing is, what impact to the market would we expect depending upon which candidate is elected? Because now there is more clarity, for example, around Biden's economic policy.
Yes.
You know, there's been much publicity around his $4 trillion tax increase. So
as coronavirus has been a staple in our market update, elections are becoming one of the things that we hope to do over the next couple of weeks is actually take the investment portfolio and run scenarios. What happens if it's a Democrat win in 2020? What happens if it's a Republican win? And stress test those portfolios to give you an idea of how the portfolio would react in those scenarios. We think that's going to be a really good way to demonstrate how they would impact. Now, granted, these are models, so
right.
You know, you gotta always remember that they're models. But that's one of the things that we hope to present either next week or the following week, so look forward to that.
Yeah, I think that'd be very relevant.
Yes. So if we move on to economic data, we had a positive week after a negative week last week. So positive is good. And one thing that drove it up was a decrease in unemployment benefit claims. So those initial claims. When you first are laid off, that's an initial claim. And it dropped to 228,000. So the first time that we've been under 1 million since the crisis started, right? And so we're at 963,000. That sounds great, but what also tells you how much uncertainty is still out there. And we've talked about how if we go too long with these lockdowns, we can turn this into more of a natural disaster event to a real recession that there needs to be systemic change. Yes, we're happy to see initial claims below 1 million, but look back to where we were prior to the crisis. So this would have been a catastrophic number.
I mean, imagine if that happened back in January.
Right. No, this would have been huge, and there would have been a lot of concern. And so I think that this still shows that there are businesses out there that are struggling, especially with the extended shutdowns and lockdowns in some of the states. So we're happy to see a drop. We're seeing unemployment drop, but there's still a lot of uncertainty around these numbers. Another thing that we kind of talked about early on is the consumer price index. We have consistently talked about our concern of inflation risk because of the fiscal and monetary policy to resolve this. We've now gone through the quickest bear market recession and recovery ever because of the amount of stimulus that has been provided. And that may come with a cost, and typically that cost is inflation. And if we look at the consumer price index for all items and look at it at the monthly basis, we saw a 0.6% increase. Now that may not seem that high, but look, we haven't seen that since 2013. And if we were to annualize it, it would be a 7.2% CPI for the year.
That'd be huge.
That would be huge. Now, we can see here that there's always ups and downs. So we're probably not going to see 0.6 for the next 12 months. There's going to be some give and take. But it just shows, here we are in the middle of a recession, and we're seeing CPI numbers move up. So that there's some confirmation, don't want to be confirmation biased, but there is some confirmation that no inflation risks are real. Just because we didn't see it in 2008 doesn't mean that we can't see it now. And then if we look at just the core, so this takes out food. Food has gone up a lot through this because it's one of the areas that most of us continue to spend money going to the grocery store or doing takeout. So the food's high. Energy is the other part that's removed, but energy is very low. No one's really doing a lot of traveling. So they kind of net out. We get that same 0.6, but for a core, we got to go all the way back to the 1990s to see a monthly print on this CPI to see something this substantial. Once again, it's the same 0.6. So if you annualize that, that core would be 7.2 as well. 1 month, but it's still concerning for us to see that while we're still in technically the recession. So moving on to our building our investment thesis and really those fundamental blocks on how we see the world and why we've done and positioned the portfolios the way that we do to really try to give some understanding and on why we were very risky in portfolios whenever it felt so scary and we all wanted to be so defensive. And some of the concepts that we've talked about is marginal utility theory, the idea that what determines the value of something is its use. Now, water is probably one of the most useful things we humans have, so why isn't it the most valuable or highest price? Well, it's not just your use value, it's the supply. So if you have a lot of water, more than what you could use, it's all going to be based on that marginal unit. So that supply, that demand will actually drive that value, but it's still that end use, right? And then the regression theorem, using those 4 characteristics of money, we explained how just in a barter economy, commodities will start to bid against each other, and eventually one will win out as the money or the medium of exchange that's used. And so once you have something that's set in as that monetary component, that medium of exchange, banking starts to come in. And especially once we had proxies where you had gold certificates, you could begin to manage the money supply to expand it or contract it through the creation of money. But of course that caused, we talked about bank runs because you created more paper money than you actually had in the commodity backing it up, and eventually you had bank runs. And the way that we solved that in central banking was to remove the commodity gold from the money altogether, and that did stop the bank runs. But we asked, well, is there a fundamental issue, at least on an economic standpoint, that still needed to be solved? Was there still a problem by expanding and contracting the money supply, or was it only the only problem was bank runs? And to answer that, we talked about stages of production, the production possibility frontier, and the loanable funds market. And we reviewed that last week, and that became the model. Well, this week, we're getting to the central bank management of the money supply and what happens to the economy when we do expand the money supply.
Now, this is the meat of really where we understand money, why we track the money supply, and so on. So this is the
Absolutely.
key concept right here.
This is one
We're
of our
now getting into the core.
Yeah, and we're getting into one of our big differentiators, I think, from others, and why we would be more aggressive when so many people are more fearful, and what could possibly give us a heads up, which it's kind of, the timing's kind of perfect because we're going to see this. So I don't want to steal my own thunder though. So the stages of production over here on the triangle, the smaller part of the triangle that further extended out, those are the early stage production. This is capital tools, things that you're investing in to make you more productive. That middle stage is when you mix your labor with those capital tools and allows you to produce, and then ultimately you're going to consume that production. And that consumption will be the point of all of the things beforehand. And you may not consume everything. So we have consumption, and here we have consumption that's actually below production. So there's some type of excess resource after consumption, and that excess resource can drop down to that loanable funds. So that will be the supply of excess resources that could be loaned out to entrepreneurs for those capital investment projects. And then we talked about, well, a drop in the consumption. So if consumers decide to save more and consume less out of their production, that will shift the consumption closer to investment or savings, or will have more excess resources. And that those excess resources will be a greater pool of loanable funds, and that'll actually drop the interest rate. So that interest rate will slide. Well, once the interest rate is lower, those entrepreneurs are then looking at a lower interest rate, and they're saying, well, that means I can take and borrow money, and now some of these projects that didn't work on a higher interest rate, I can pay them back. So there's now some new economic development. There's capital production that's happening within the economy. And the point of it is to expand the production capacity of the overall economy, which then will ultimately increase our production possibility frontier, meaning that if we were doing 5 fish before and now this new advancement gives us 7 fish, we now have a trade-off between consumption and investment that's different.
It actually increases the standard of living as well.
It does. And in this scenario, we can see that our consumption, let me go back there, actually increased, and our investment, or what we were saving in excess, also increased. So that's how the market balances, how the interest rate and the consumption versus excess resources and capital, it's how all of that works together and finds equilibrium. And here would be the equilibrium. And then the item we're going to go over now, pulling back from that old story of the goldsmiths that became bankers, that began to expand the money supply. So they had 20% of the gold as reserves, and then they made 5 certificates. Well, what would happen in this model? So the way that a bank's going to work, it's going to work down here in the loanable funds area. They had savings pool that was being provided by the economy, those excess resources, but they're going to expand the money supply. So it looks like there's more excess resources to lend out, and it's going to drop the rate of interest. Well, that interest rate drop is going to allow for new capital projects to come on board. Now, what didn't happen is we didn't drop our consumption. So we don't have those excess resources to build those capital projects, and our interest rate is lower. Well, if the interest rate is now lower, you're less likely to save because you're not getting rewarded for that savings. So you're going to likely consume more. So now you have consumption increasing and investment increasing at the same time. And we don't have any excess resources. So we're actually above the production frontier. There we go. That's moving now. So going back to the old GDP equation that we talked about, it feels like eons ago, where GDP equals consumption plus investment plus government spending, and we're ignoring exports. If consumption investment has gone up, well, most likely economic activity has gone up, so government spending has gone up. So based on that increase in the money supply, we see consumption investment go up and really GDP go up. Right? And it all seems great. Who doesn't like this? You can print money and you see the GDP expand, except that let's look at those fundamental components, right? We have consumption increasing, we have investment increasing, we have less excess resources, and we have more money. So we're really burning the candle at 2 ends. It's not being balanced out. So if you have excess money chasing less resources, so you're competing both for consumption and capital projects, you see prices increase because they're both bidding after the same pool of excess resources. And that is what we typically call inflation. I think the inflation is actually the expansion of money supply. This is just an effect of that inflationary policy. So then what happens? Well, I wanted to say the Federal Reserve because that's our central bank, but the central bank would see the inflation happening. They're going to combat that by raising interest rates. Well, how did they lower interest rates? They lowered it by creating additional money. So how would they raise interest rates? They would contract that money supply. And that interest rate's going to move up. Well, those capital projects that were based on that lower interest rate, some of them are going to have to be mothballed. We're going to have to take those off. So that stage of production will actually decrease. We'll invest less. Think of a typical recession. How many projects stop because of we're moving into a recession? So we
see about 2008.
That's right.
It was a dead stop.
And then what else do we do? Do we continue to consume? Well, one, interest rates are now moving up, so we're less likely to consume because we get more benefit from saving. And also we're nervous, the uncertainty, right? So we actually bring down our consumption. Let's go back to our equation. If the consumption's going down and investment's going down, there's not much economic activity, so government spending is probably going down. I know that's the way they're going to combat that, right? They're going to increase government spending in a recession. So we would see a contraction in GDP at that point as we're healing it. Well, that's our boom and bust. And it's the expansion of the money supply and eventually the contraction of the money supply to slow down the inflation that's causing this whipsaw in the market.
So if I can kind of summarize this, when the government and the Fed, through their monetary and fiscal policy, increase the money supply, that means there's more money being put out there, there's lower interest rates, it pushes up asset prices. So the stock market, for
Yes,
example.
well, that's a capital project, right?
That's
funding
project.
capital project.
So as soon as they turn around, they start to shrink that money supply. That's going to cause the capital projects or the capital markets to shrink.
Right, but it's also causing the consumption to do the same thing as the capital. So that interest rate is no longer balancing the trade-off of consumption versus savings. So since it's not there, we get into a disequilibrium. So at first we see a boom. So we saw the money supply take off, and we stayed aggressive, knowing that asset prices were going to move and it's going to look like it's great. We wait for inflation to show up, and then when the Fed starts to act and try to contract the money supply, whether inflation or if it's just contracting the money supply, that's when we want to get more defensive. And the point of this is, so yes, you summarized it, and here's the boom bust. No reason to repeat it because you did such a good job on summarizing it. It's the money supply. Right?
So let's talk about where are we with the money supply now.
Exactly. So this top left quadrant, I guess I don't have four things, but we're going to pretend that there's one over there in the fourth quadrant, right? It was the money supply, and we like to measure it on a 13-week average, non-seasonally adjusted. We're trying to basically dress for the weather that's current. And we can see that during about week 13, as we got into this crisis, the Federal Reserve, the government stimulus, all started to make it into this market, and we can see a rocket ship. It gets all the way up to an annualized 60% growth rate. But at some point after 13 weeks of, you're looking back at increasing numbers, you would expect it to drop down. So that's why in this other top right-hand side, we started to look at the 52-week to try to understand what was actually happening there, or was it just the quirkiness of the 13-week math? And we could see that we're still very high. We got up to 25%, but now we're moving down on a 52-week, and we're moving down on the 13-week. We're starting to see a slowdown. Now, there's a lot of money in the system. We're still 20% higher than we were a year ago. So there's no red alert here. But when we look at the money supply, we also see a contraction. Now, what we don't see is the executive orders. That money's got to come from somewhere. We know that the government doesn't have money. Well, I guess they do. They have the 1.8 billion that they created, right? So from last time. So there's still some money that they could have, but they're mainly going to borrow, and that borrowing is going to be monetized by the Fed. So we could still see the money supply begin to increase. But nonetheless, we're seeing that contraction in the money supply, and we're not permabulls. We're not permabears either. We want to start operating based on what we see on our technicals as well as our money supply numbers. So we are recommending for our clients that are in or approaching retirement. We had a 24-month cash hub where you set aside cash to weather a storm so you didn't have to touch your investments. We're making the recommendation to lead advisors that you can take that all the way up to 36 months now.
That's a really important call for right now, especially because we've been getting phone calls from clients saying, hey, we're already at market highs.
Well, the market has now recovered, right? We've hit all-time highs, and we've done much better than the benchmarks. So we are much higher than we were at these previous highs. So we do think it's prudent to start taking some chips off the table if you need to get access to that money in the near term.
Well, let's talk about people who are not nearing retirement, but they're still in the accumulation phase of life and they're trying to save for retirement. What would you recommend for them? Because we also recommend that they have a cash hub, for emergencies.
And we call them different, right? We have an emergency reserve and a cash hub, but they really serve the same purpose. Is having liquid funds available So for somebody that's working, if they lose their job, if there's a recession or something, they don't need to tap their investment portfolio. Well, it's the same thing for those that are in retirement. It's just those in retirement are more likely to need to access the funds than a person that's still in the accumulation phase. So yes, if your emergency reserve should be somewhere between 6 to 9 months, and you'd feel more comfortable seeing 9 months, it's okay to go 9 months. I wouldn't go too much further because these are short-term problems. If we were to see a contraction in the money supply, the Fed's going to act. We still think the market's going to continue on and move up. We are not calling the top by any means. So we think it's more likely that you would have a cash drag. But from a planning perspective, as long as your long-term goals are not hindered and it makes you feel a little bit better, and there's the opportunity, if we do have a correction, to put some of that money back to work, to have that conversation with your lead advisor. We are now well ahead of plan, and it's okay to build a little bit more of a cash cushion. And if you don't have a cash hub, and it's something you've been hesitant to do, I wouldn't recommend just going out and pulling 36 months out. But maybe this is the time to take a little bit of the chips off the table and start to build that cash up, putting 12 months or 24 months, depending on where you are.
I think it's important. So when we're talking about taking chips off the table, we're not making the portfolios changing the allocation of the
Right.
portfolios, because the portfolio is going to be determined by a risk profile and the time horizon for each individual investor.
Right.
But this is to position them. So if they have 36 months, well, that's, as you said, that's going to take them beyond the next election.
And you think of that short-term bucket, mid-term bucket, and long-term bucket. What we're doing is just reducing the amount or changing how much money is in each of those buckets. And if you have more money in that short-term bucket, then you can still remain aggressive in that midterm because you're less likely to need to get access to it. We're not becoming more defensive in the investment portfolios, at least not at the moment.
By the way, I do want to put a plug. We have on our YouTube channel a video that you produced on cash investor keep, and basically you demonstrate on that videotape how keeping your money invested in the market while having a cash hub to withdraw from during down markets when you're retired actually produces a better result financially for clients.
Yeah, and absolutely. So once again, this is not a we got to get out of the market type of thing. This is a planning component, and we think that we are well ahead of plan. So long as your goals can still be achieved with the remaining, it's okay to take a little bit of the chips off the table here. So please talk to your lead advisor, whether it's an emergency reserve or it's starting a cash hub or it's expanding your cash hub. And then we have our themes, and I'm hoping with today's presentation, it's really starting to give us some light on why we think inflation risk is high, because of the amount of money that has been created in the system. Now, I say the inflation was the expansion in the money supply. Sometimes we see the rise in prices. Other times we don't see that, and it could be just we see the Fed act to lower interest rates, and people actually do consume less because they're concerned because of the way the Fed is acting. Right? There's a lot of moving parts in the economy. A model is always an oversimplification. So
yes.
It's just to demonstrate a concept. But now we have the tool, and we can start to talk about favoring equities. We're not going to do that on this call. But we now have the tools to start assessing why these themes are what they are. When we look at the price points, we continue to climb that wall of worry. Whenever I grab this image, we had not yet hit new all-time highs. We've hit new all-time highs in the S&P 500, continue to climb that wall of worry. We believe it's more likely that we will move further up in the market. That's one of the reasons we're not becoming defensive in investment accounts at the moment. We are certainly reviewing portfolio insurance concepts, considering different bond alternatives, making changes. But at the moment, we encourage people to stay invested, stay risky. We're just taking some of those excess returns in that middle bucket and saying, if you might need some cash, let's go ahead and put that money in there. And once again, if you have that 36 months, not only do you get through this election, you get through the next election. So you have a long time to really kind of let those assets in the investment account work.
So let's talk about the money supply in terms of the new stimulus package, which is not passed. So in essence, right now, Congress is stalled because they haven't agreed to a new stimulus package. And in essence, that's just putting more money into the system, right? That's increasing the money supply.
Yeah, with a stimulus, if it was a pass through.
Right, if it was a stimulus. Has the market already anticipated a stimulus being passed, and what would happen if it's not passed?
I think the likeliness of a stimulus being passed, if we continue to improve the way that we do, it's probably not going to get pushed forward. And the House is probably very much inclined not to push that through, because if we have that stimulus, it will probably make the economy at least look better. Remember, C plus I, right? It's going to go up.
Right.
So they're probably more hesitant to let anything happen and pass.
Right, so a Democratic-controlled House would likely hold back on that. So
Right.
Because
We're getting too close to the
because if it does look better, that would possibly favor Trump.
Right. So if we don't have a crisis or a situation where if the Democrats were slowly dragging their feet to prevent that from happening, they would then be able to be portrayed by President Trump as do nothing and being in the way.
Yeah.
Without some type of compelling reason for them to move forward, I think we're less likely to get the stimulus. Once again, though, they use executive orders to get some of the things done. Was it $1 trillion? No. I personally hope we don't have as much debt. This slows some of that debt growth in the U.S. And if we have enough in the system and we get some certainty about what the future is, there's probably enough money that's out there to push us forward in the economy. So I'm personally hoping that we don't have a stimulus package because it's not needed. Still yet to be seen, right?
So what do our technicals look like now?
Our technicals are strong. It's keeping us invested. Let's go through like the dollar. One thing we've continually talked about our concern with the dollar, especially our overweight to U.S. domestic market. We think that's right. When we look at our technicals, we can see that this is from the previous week: technology, mid cap, small cap, gold, emerging markets, commodities are starting to move up as well. These are all strong areas. Minus commodities, we have adequate exposure. We do not have a commodities or diversified commodities fund in the portfolio, but that's because we have gold miners. And gold miners tend to be a leverage play on gold. So if we have 5%, it really kind of feels like 10% on the volatility.
So moving beyond the performance, last week, or at least it was announced this week, that Berkshire Hathaway had purchased a large amount of gold miners. Mm-hmm. We also heard that some hedge funds like Blackstone purchased almost $1 billion worth of gold miners. But it seems that the timing of that was not that great because gold has risen so much. Did they buy at the wrong time?
Well, you're only going to be able to tell that with you're investing in the rearview mirror, and we're not far enough along. Gold is at an all-time high, but it's been in a bear market for quite some time. So if we were to inflation adjust to that, my bet is gold is not at all-time highs. It'd probably be close though. But no, I think they're making good decisions because really it's the fundamentals. We have moved from modern monetary theory to modern monetary practice. We are beginning to monetize debt, and there is concerns about the way the United States is treating its currency. And I would not call Warren Buffett anything resembling a gold bug. And he probably didn't make the investment decision to buy the gold miners. But when you're looking at those the fundamentals, there's a strong case based on the fundamentals on why you want to have gold. Does that mean that gold couldn't all of a sudden things look great? Inflation's going to be moot. The fiscal issues that the U.S. government has are going away because the economy is growing so substantially that we're going to be able to grow our way out of it. All of those would certainly detract from gold, but there's a reason that a lot of smart people are starting to add that. And just think of what would happen if most of the portfolio managers out there, people that are helping clients make their asset allocation selection, decide to add 2% of their portfolio to gold. There would be an enormous amount of increase in the price of the metal. And I don't think that's going to happen, but there's certainly the risk of inflation going forward. Everyone's aware of it. Treasuries are not yielding the low inflation rates now, so that makes gold a compelling hedge against that possibility of inflation.
Now, the Wall Street Journal this morning showed or announced that Apple had passed $2 trillion in market value.
Yeah, it doesn't seem like it was that long ago when it passed 1 trillion.
I mean, it's like, how many zeros is that?
It takes forever to make your first trillion, but your second trillion doesn't take hardly any amount.
Exactly. Yeah. I used to say that about the first million, but your first trillion, wow. Is there a risk that we should be considering when companies get so large that it's almost hard to comprehend the magnitude of the operations, the complexity of the company, the massive amount of revenues, and so on?
Well, the massive amount of revenues is one of the reasons that you have those valuations, right? We also have to compare it to, look at that stimulus package. We added 3-something trillion in debt because of the recent stimulus package. That's more than Apple. We just took on 1.5 times one of the most valuable companies. Is it the most? It's the most valuable company.
Most valuable company.
We spent that in a quarter in additional debt. So that's the size of numbers. I mean, we're talking about real money now, right? Trillions of dollars. It really is incomprehensible, but it's also just the size of the economy.
But are there risks that we haven't thought about or that we would consider when a company gets to be that size?
Well, it's compared to what? Because all the other companies are also growing. Is there risk? There's absolutely always risk. But the market is assessing a value, and they say Apple is a good place to put money. The market's not perfect. Are there risks that we don't know about? Absolutely. I mean, that's just that's why we have the word black swan, right? Because there's unknowable risks that are always present, and it's always the unknowable.
Right,
but
well,
they're unknowable because they're unknowable.
That's why you have the whole concept of diversification. You
Right.
don't want to have more than a certain amount of concentration of one stock in your portfolio, because just in case that unknown risk did happen.
Right. If you could go back 20 years and buy nothing but Apple stock, you're probably going to do quite well in your portfolio. But
I don't have a time machine to do that
no,
yet.
neither do I.
So, regulation has certainly been lifted in many areas under the Trump administration, but there is still political meddling on a local basis. For example, Uber and Lyft, California had sued them to have them classify all of the drivers as employees as opposed to independent contractors, and a judge agreed with that. So now Uber and Lyft are considering suspending operations in California so as not to have to comply with that. What impact do we see going forward with governmental meddling or intrusion?
Well, I'm fine with the word meddling, but I'm a free market guy. I do think it's a problem and it's an issue. It's one that Uber will figure out on how to work around. So it's going to be a temporary suspension. They have some plans that they already have in place to change the way that their contractors work with them to get around some of the regulation. But I think ultimately the issue, because the big companies will figure out ways, is the consumers hurt because it's going to make Uber more expensive in California. And Uber has done a great job of making the taxi-like service lower cost and more convenient. How many lives have been saved because we haven't had nearly as many drunk driving accidents and it's because Uber. It's so convenient, it's so easy. So it's not just the consumer that will be hurt, though. It's the small guys, right? It's the new up-and-coming companies that are really going to have the regulatory burden that doesn't have a staff of attorneys to figure out the ways to get around these regulations and have some political power to make sure that there's back doors put into provisions so they can game it. So I think ultimately it's the consumer and those future small companies that could grow up and have the impact that Uber and Lyft have had And one of the things that I did notice here lately, and longtime listeners probably know that I'm not one to be ultimately concerned that China is going to pass us up and the U.S. is going to be forgotten, but China's just passed the U.S. in the number of Fortune 500 companies. It's 183 to 182 now. Now, prior to 2008, the U.S. was substantially far ahead. Well, how much have we set in these different types of policies? Remember, too big to fail, where we have favored and set in as policy the large corporations to the detriment of the small corporations. We're just not generating the small corporations that we used to generate, and it's really stifling innovation. And ultimately, as we looked at the way that an economy grows, it's that innovation, that capital projection, that building of new companies that lift the standard of living. So I think it's concerning whenever governments begin to use regulatory apparatus to favor some groups over the others, whenever there isn't a real good justification, especially from the consumer standpoint. But once again, I'm a very much a free market guy. So I'm sure if somebody is very pro government regulation and needing to check the market, they could have an argument that is compelling and has good reason to. So
yeah, I think just from our standpoint, the thing that we look at is what does that mean in terms of how we view stock company pricing, right? Because if the future of the company is dependent upon its earnings, but then all of a sudden there's this support when there are no earnings that's outside of its own control, how do we then go look at markets going forward, right? Because there's this artificial influence.
Well, I think this type of movement, right or wrong, is going to favor a large company over the small companies, and it's going to raise prices for consumers.
So it looks like we're out of time. And I want to remind our listeners, of course, that any discussions around any specific stock or mutual fund is not an endorsement to buy or sell, but simply commentary based upon each commentator's opinions, and all investments have risk. Past performance is not indicative of future results. We've heard that one before.
We have.
So this weekly broadcast is open to the public, so please feel free to share the link on our broadcast and social media to your friends, because they are more than welcome to listen in and learn our perspective on the market and the economy. And what was that bell thing again?
That bell right down here. Click that bell and subscribe.
We're trying to get our readership up.
Our viewership.
Our viewership. We also have readership for those who read the commentaries. So thanks again for listening in to today's broadcast, everyone. As always, if you have any questions, please contact your lead advisor or any member of your team. We are here for you.